Hello and welcome to Reviewing Your Money. By now you should have seen video 1 of this class titled The Big Three Financial Documents. This is a course on financial statements that is presented by Lift Fund as part of our Grow Now curriculum in conjunction with the SURE program and the Bauer College of the University of Houston. My name is Jennifer Dale and I will be your presenter again today. Let's get right back to it. Just to reiterate, our goals today are to discuss the major financial statements and what they will tell you about your business's current and future financial position. In this video, we're going to discuss some basic accounting principles and provide you with some tools and recommendations to gain control of your finances. Specifically, our key goals are to reiterate that financial documentation is a tool for you as the leader of your business to track the financial health of the business. We have reviewed the profit and loss statement, the balance sheet, and the cash flow statement. In this video, we're going to be analyzing your financial statements and spending some time talking about projections and budgeting as well as leveraging debt for growth. One of the key concepts in accounting is that there are two separate methods for accounting, and they are both valid under different circumstances. The first is accrual-based accounting, and the second is cash-based accounting. Accrual-based accounting accounts for everything when you earn it, owe it, and use it, accounting for everything as it accrues or as it happens. So for example, if you have a contract and you fulfill the contract, but there is a waiting period between when the contract is fulfilled and when you actually receive payment on the contract, accrual-based accounting would take into consideration the fact that you have earned that money even though you have not physically received it. Likewise, if you owe funds that you have not actually paid, accrual-based accounting would take into consideration what you owe during the period of time under evaluation, whether or not the funds actually left your hands. So it is considered a more complete accounting system. Cash basis accounting accounts for everything when the cash actually comes in or goes out. The primary example of cash basis accounting is when we do our taxes. We don't pay taxes on accounts receivable. We don't pay taxes on funds that have not actually been paid to us. And also for certain cash-based businesses that don't have any kind of receivables or payables, cash basis accounting is generally sufficient for what they are trying to accomplish. So with that being said, now we're going to talk about a few of the financial indicators that you should be taking a look at. When you're reviewing your balance sheet, there are certain key indicators that you should consider. The first is, are you growing your balance sheet each period? If you remember from the first video, we showed the balance sheet of a very simple business, our lemonade stand. We started off with $15 in assets and $15 in liabilities and equity. The idea is that under the next period or at the next period under review, that balance sheet would grow. Perhaps we have $50 in the asset side and $50 on the liabilities and equity side. But every time we prepare a balance sheet, in theory, the balance sheet should be growing. The second question that you may want to ask yourself is, how liquid are your assets? If you look at the top box here, you'll find a formula, your current assets divided by your current debt, your current liabilities. This formula is called the current ratio formula. And what it does is it predicts your ability to handle your short-term liabilities like payroll taxes or other immediate payables. Basically, it lets you know how solvent are you, how liquid are you, and how reasonable is it of an expectation that you would be able to cover your immediate expenses. Another key question to ask is, how are you leveraging your debt? So when you look at that, you're going to want to use this ratio, which is the total debt divided by your total assets. This ratio is an indicator of your financial leverage. It tells you what percentage of the company's total assets are being financed and what percentage of the total assets actually belong free and clear to the company. And both of these are strong indicators of the overall financial health of your business. For the profit and loss, we'll be looking at a different series of questions. On your income statement, one of the key things that you'll want to see is, did you actually have a profit or a loss? So if you remember our example, you'll remember that we said that the income statement is essentially a worksheet to determine whether or not within a specific period of time we had a profit or we had a loss. Some of the key ratios for your industry will also depend on measurements that are found on your profit and loss, and to include this ratio of your net income by your net sales. What this is going to tell you is your net profit margin. If that net profit margin is well out of range with other companies in your industry, then you might want to ask yourself some questions about how can you do business more effectively or more efficiently so that you know that you're maximizing your profit. You'll also want to compare that to previous periods to see if your net profitability has increased or if it has decreased. And lastly, you're going to want to compare it to your budget. So were you able to produce as much as you wanted? Were you able to produce as efficiently as you wanted? Were you able to keep your expenses under control? If the answer to any of those questions is not what you expected it to be, then you should look at the financial documents for the answers to why, and then make adjustments about your future behavior. For the cash flow statement, one of the things that you're going to want to take a look at is where are the ebbs and flows when comparing all of the months in one report. If you see that your cash position is significantly stronger during one period or significantly weaker during one period, then it will allow you to effectively prepare and to have the cash reserves on hand to make it through that period without a significant crisis for your business. Essentially, by monitoring all three statements, you can now analyze your company's financial position and make much more informed decisions. You will know, where are you spending the money? Are you making enough to afford another employee? Do you have a cyclical business? And is that a good thing or a bad thing? Where are you able to cut some costs? Are you able to spend more money on advertising or to take on a new project? How much am I going to owe in taxes at the end of the year? So by analyzing the financial statements all together, you'll have a much better sense of the overall financial position of your business. Now that you know where you stand, you can also plan for growth. So I know that a lot of the businesses that are watching this video may be startup businesses. At this point, what you would be doing is you would be comparing the financial statements or an accumulation of financial statements from existing businesses in your industry and using those to prepare a month-by-month projections template. So whether this is for an existing business or a startup business, that's what you're going to be trying to do, is taking a look at past behavior to try to predict reasonable expectations for future behavior. One of the key things to remember as you look at your projections is that every number on your projections should be justifiable. They should either be an indication of the industry standards, or it should be a reflection of some cost that is fixed by a third party. So for example, your rent. Or it should be an assumption that is based on what sets your business apart, what is unique about your business, but it should be justified by you at the same time. So when you're getting ready to set up your month-to-month projections, you're going to refer back to your sales strategy and your forecast to determine your monthly percentage or dollar amount increase to your revenue. Then refer back to your marketing and hiring strategy and consider what additional expenses will you need to account for. And lastly, you're going to be able to determine if external funding will be needed to get you through those ebbs and flows in your cash flow projection. With all of that in hand, you will have a very solid idea of whether or not this is the right time for you to take on a new project, a new employee, a new strategy, or if it's time for you to refine your existing strategies. If you are looking for working capital to embark on a new strategy, it's important that you prepare yourself for growth by looking at the 5 C's of credit. Generally, the 5 C's of credit are defined as character, which is a measure of how you have handled your debt in the past; capacity, which measures your ability to repay the debt; capital, which measures your equity, whether it's savings that you have to start a business or equity that you have left in the business; your collateral, which measures what you own and what you can pledge to support the repayment of the loan; and other conditions such as the market timing and so forth. So, with all of that being said, now it's time for the homework. I would like for you to spend some time asking yourself, where do you stand with regards to your financial literacy about your own business? Do you have financial documents that are prepared? Do you know some of the key indicators or key ratios that you would need to know in order to evaluate the effectiveness or the efficiency of your business? Do you know what the industry standards are for other individuals who have a business that is similar to yours and how your business compares? And have you done an analysis of the 5 C's of credit to evaluate your overall financial health and your readiness for growth opportunities? Take a few moments to think through those questions and do the necessary work to get yourself prepared and to the next level. Thank you so much for engaging with us on this workshop. Again, this workshop was presented by Lift Fund as a part of our Grow Now curriculum in conjunction with the SURE program from the Bauer College of the University of Houston. Have a wonderful day.